Welcome to another episode on the Retire Zenith channel. I'm Robert Martin, a partner and founder at Zenith Retirement Planning, also a chartered financial consultant and a certified tax specialist. Today we're going to be talking about navigating mutual fund tax traps, how mutual funds, although very diversified and can offer benefits as such, their tax structure can actually create unexpected taxes for you. When another investor wants to sell their stake in a mutual fund, that fund must sell their assets to cover that payout. And sometimes, if those assets have appreciated, not for you, but within the fund, that fund incurs capital gains, and it's a rule that all shareholders must be responsible for paying that tax. So therefore, you could pay tax on a mutual fund. On income you've never received, your investment advisor may not have even sold your mutual fund, yet you'd still be responsible for paying some kind of tax. Let's check it out. Now, when we're navigating mutual fund tax traps, another term that you could use for mutual fund tax traps is a phantom tax, because it can phantom its way through the walls of a mutual fund onto you and create tax. Now, by the time I'm done with this section, you might be feeling a little bit like this, and that's totally okay. It's something that some investors have no clue about, and then some investors do, yet they pay this unexpected tax anyway because they actually think it's normal. But to understand this, we actually need to understand what a mutual fund is, okay? Because you can pay tax on income you've never received from it. And when we consider a mutual fund, I want you to imagine that you have a bag of goods. Now, unlike this screen, let's say inside that bag of goods, you have some golf balls, you have some eggs or bread, maybe some trash, right? Now, you may know exactly what's in your mutual fund, and you'd say, no, that's not trash. Or you have an investment advisor that manages it for you, and you really don't know how you're being invested. Either way, the value, like anything, is based on what's inside of that bag, and that's the mutual fund's value. Now, I want to take it a step further. Let's say that you went to Wegmans for a curbside pickup order, meaning you gave your grocery list to somebody inside the store. You parked in the parking lot or right outside the store, and someone's inside shopping for you, and they're finding stuff on your list. They're putting it into your cart. If they find a better alternative, they're going to take stuff out of the cart and put something else into the cart. Well, when that happens in the mutual fund world, that creates tax that you could be responsible for. And I'm going to provide an example to actually help you understand that. So like that bag of goods, if you bought a mutual fund, you're going to have different stocks, different company ownerships inside of that mutual fund, kind of like this, what we call a beautiful pie chart here on the screen. Now, I want you to imagine that back in 1980, the mutual fund that you bought this year bought Apple stock. Now, Apple stock has thousands of percentages of gains that have never been unlocked, haven't been paid tax on. The manager inside that mutual fund, let's say because they don't want to own Apple stock anymore inside the mutual fund, they decide to sell all of Apple stock. So now we have thousands of percentages of gains that have never been taxed. And the tax rule is, because you are technically a shareholder, like everyone else who owns that mutual fund, all of that gain is going to be sliced and diced and passed on to you. Even if you didn't sell anything, even if your investment advisor didn't sell anything, even if you never got a paycheck or if you never got any income, you could still be responsible for paying the tax on this. And you'd be surprised how common it is. I had one woman who we did a 1040 analysis, and we uncovered that she had in fact had $40,000 of gains come through onto her 1040 to become taxed that she was completely unaware of, because she just took the information that was given to her every year and she gave it to her accountant, and the accountant didn't ask any questions and filed her taxes and then told her what she had to pay. I met another gentleman who knew this was happening. He just didn't know it wasn't right. He didn't know that, it wasn't normal. Last year, he had $100,000 come through and he had to pay tax on. So it's really important to consider alternatives. Now, this mutual fund problem specifically happens when you own mutual funds inside of a brokerage account or a regular investment account. If it's inside retirement accounts, you're totally fine. A solution would be to use exchange-traded funds instead. Now, just like a mutual fund, they are exactly the same with a few key differences, but on the outside, they're both bags of stuff, and the value of that bag is based on what's inside the bag. Now, here's the difference. The mutual fund has a manager, and that manager's responsibility is, yes, to buy and sell stuff inside that fund, therefore creating tax, like we just discussed. And because there's a manager, mutual funds tend to be much more expensive. You'll see the cost of mutual funds. This is not including what you pay to your investment advisor, but we see the cost of mutual funds being between 0.5 and up to 2%. ETFs, on the other hand, don't have a manager. They don't have a manager buying or selling anything, and because there's no manager, the fees are typically between nothing and 0.2, which is much less than a mutual fund. Now, the ETFs and mutual fund, they go hand in hand. There's an alternative ETF for every single mutual fund that's out there for the most part. So, when we're talking about how to decrease and even eliminate taxes in retirement and navigating mutual fund tax traps, it's important to consider that decreasing your taxes is not just about going to an accountant. It's not just about Roth IRA conversions. It's not just about deductions and credits or business organizations and structures. How you invest also impacts the kind of tax you pay. And with that said, that's how you should plan to navigate mutual fund tax traps, also known as phantom gains. If you appreciate the video, please give us a thumbs up and subscribe so that you can get access to all of our videos, get alerts when they get released. As soon as they're released, if you didn't like the video, we appreciate your honest feedback. Give us a thumbs down. If you like the video, thumbs up, drop a comment or a question if you have any, and we look forward to seeing you on the next one.